Okay, for this third segment of our chapter 4, we're the first problem here in our practice. So what this is, a elongated income statement with our sales minus cost of goods sold equals gross profit minus our expenses. This is more of what we're looking at. They don't put in the sales return and discounts on this one, so they basically start us out with net sales, and then we're going to figure up our cost of goods sold based on the inventory. And we're using gross profit, then we're going to get gross profit minus our expenses to get our income. Okay, so let's go back up here. Remember, we take our beginning. The main thing we're going to be figuring out for a lot of these is somewhere in this category here with figuring out cost of goods sold. So here they give us the sales. And then they tell us what the cost of goods sold is, but they want us to be able to determine what would have been our ending inventory if this would have all been the case. And notice here it tells us if any amounts to be subtracted, they want us to put it in negative like they do for all these other ending inventory. And so our answer here will be a reduction, because if you come up here and you look at our formula, to get cost of goods sold, we have to take our beginning inventory plus purchases. They don't have anything about returning anything, so they're just giving us this plus this, and then they're not even figuring up the equal sign. That's fine, you don't have to. But this plus this minus the ending inventory, that's what we're trying to find here, will give us our cost of goods sold. So all we want to do is just reverse and work this problem just a little bit backwards. So the total goods that we have available for sale are the 8,000 plus the 38,000. So we've got 46,000 ready to be sold. And if I end the day out of the 46, if I end selling 34,000 of those, how much do I have left? And the answer would be I have 11,000, and I'm going to put that in as a negative because we're subtracting 11,950. And that gets us to our cost of goods sold. And then this one, getting the gross profit, is very simple. Just take our sales minus our cost of goods sold, which they just give us to us in the problem. Sales minus $34,050 gives us a gross profit of $27,950. And then when you subtract out your expenses, you can just do this one in your head. Minus 10,000, 17,950. Let's look at number 3. What I think is going to help is I'm going to pull up a T account sheet, and you may want to do this just on a side scrap piece of paper, or pulling up a T account sheet may help as well, but I think it'll help you for visualization purposes to. Now the ones we did in our part 2, segment 2, were actually a little bit harder than what these are going to move. And let's start in here with on April 2nd, purchased $4,600 of inventory or merchandise, same thing, from the Lion Company with credit terms. So that means that we bought it on account. They're not going to give us credit terms if we paid cash. They're just going to go ahead and give us the discount if one would apply. If we pay within 15 days, we get 2% discount. Otherwise, we pay everything. Everything's due in 60 days. And it says it's FOB shipping point. Now, they don't tell us the amount of shipping. That's going to come down here on number 3. That's one of these where it's a little bit easier on this problem. They separate it out, whereas I put it all together in an example. Actually, this one, all we want to do is just debit our merchandise inventory. They call it merchandise inventory. In my example, I just call it inventory. Same thing. $4,600 is what they bought. Right now, we don't know if they're going to pay it or not. So we're going to just credit our accounts payable to the Lion Company for $4,600. Simple as that. This one's pretty simple so far. So I come over here in my merchandise inventory for April the 2nd, $4,600. And we had an account payable to the Lion Company. $4,600. Okay, we paid $300 cash for the shipping charges. Remember, that comes back to our notes. Our notes say anything that gets the item ready to use or sell goes into the cost of into the merchandise. And one of those is the FOB shipping point, shipping coming in. So we're not going to debit shipping expense. We're not going to debit anything like that. We're just going to simply debit merchandise inventory for $300. And credit, it says we paid cash we directly paid for the shipping company. That's not generally how it works in real life. Usually the buyer isn't paying the shipping company. It's usually the seller. So that's why I do it differently in my examples. I try to make it a little bit more real life. But if this was the case, this is how it would have worked out. We still debit. It's still going to end up similar to how I did it in my examples. With the inventory is going up. That's the ultimate thing that's happening here. Inventory is going up by $300. It's just that in this case, we're paying the shipping company instead of us paying the seller, because the seller's paying the shipping company. That's how it really works. Okay, so we got that one done. Now it says we returned some bad merchandise for $600. Well, that all goes back again to any cost that gets the item ready to use or sell, and one of those is a return. So if we're going to return something, we're simply going to undo part of the original entry. We originally bought $4,600, but we didn't buy that much now. We bought $600 less. So on, let's say it's the next day, I don't know if it is, we're going to return $600. And then simply they're going to, instead of giving us the money back, they're not going to give us our money back because we haven't paid yet. So they're going to take $600 off of our bill. So we're going to come here and do an account payable. It's a line for $600, and then credit our merchandise inventory $600 and record the entry. Now it all comes down to our final payment here on the April 17th. It says we sent a check to the Lion Company, and net of the discount and the return merchandise. Okay, so that's telling us that we probably got the discount. It's giving us a little hint. So let's go back and check to make sure. It says as long as we paid within 15 days, we get 2% discount. They haven't talked anything about sales tax like I do in my problem, so we don't have to worry about taking that out. Okay, 2% within 15 days. So as long as we pay by the 17th, and it says here it is the 17th, so we just made it. We get a 2% discount based on what we still owe. So remember, right now we have a balance. If we were going to balance this out at the moment, put our lines in, we have a $4,000 balance. When it's all said and done, I want that to be zero. So to make that go away, my first order of business is to show that I have an account payable debit to Lion Company of $4,000. But my credit to cash isn't going to be $4,000 because they're giving me a discount of 2% based on this number, my net, what I actually purchased, because I didn't really purchase the $600. So if we get out the calculator and take 2% of $4,000, $80 I get to take off of my bill, and that's what I'm going to pay. When I pay cash, I'm not going to pay $4,000. I'm going to pay 80 less than that. So that comes out to be $39.20. Right now, my journal entry doesn't equal. And one thing I do not want to do is I do not want to come up here and put $39.20. Because if I put $39.20, that shows I still have a balance. If I come down here and put a balance in, I would still owe $80. But I don't. I owe nothing. They gave me a discount. So I need to show that. I need to put this at the full $4,000. What really happened is I paid only $39.20 for the inventory, not including the shipping. So that's what really the inventory cost me, was $39.20 without the shipping. So I'm taking away $80 of the inventory cost on $417. And that is my final credit for the merchandise inventory. Okay, now pretty much very similar. We're just going to do the next one here. It's the only difference is it's FOB destination. So therefore, there is no shipping costs that we have to worry about, because remember with the FOB, I told us what it really stood for, free on board, but really what we want to think of it as is free to the buyer. So it's free to the buyer, the shipping, all the way till it gets to our house. So that's good. We don't have to pay any shipping. So even if they told us the shipping, we would leave it out because it's not part of our bill. We purchased $8,500 of merchandise, so that's easy enough, $8,500 with credit terms. So that means I bought it on account, and it says I bought it from First Corporation. So we're going to do accounts payable first. Easy enough. Now this one I'm just going to remember here that it was 110. So as long as I pay by the 28th, I get a 1% discount on my net purchases. Now it's telling us here that we received an allowance. Basically what that's meaning is some of the inventory was probably damaged, but instead of giving it all back and them giving us a full credit, they're just saying, keep the inventory. We're just going to reduce the cost of it a little bit. We're going to take a little bit off of your bill. Okay, great. So my inventory actually went down by the amount. So it was originally $8,500, but now it's really only worth $8,000 because they're taking a little bit of money off of my bill, $500. So therefore I take a little bit off my inventory costs, $500. So my inventory only cost $8,000 net. Now on the 28th, so remember that was a date that we had to remember, we're going to go ahead and get the full discount. So we get a 1% discount of the $8,000, not the $8,500, because that's not really what the full price was. The full price was $8,000. I get a 1% discount. That's again $80 if you do the math. So we're going to take, first off, we're going to reduce our accounts payable by the full $8,000 because I don't owe them anything anymore once I make the payment. I'm going to pay cash of the $79.20 and credit my merchandise inventory by that $80 discount that I received. Record the entry, and then if we check the work to make sure we've got everything good, and it looks like we do. Okay, go on, here we go. So now this one, the only thing different with this example is we have shipping. So let's see how it works. We're going to do, again, we're going to look at, looks like we're going to do it from maybe both perspectives. I'm not really sure. Yeah, required 1 and required 2. Sydney is the buyer. Troy is the seller. All right, so first we're preparing entries required 1. It says from Sydney, the buyer. All right, so let's go through these. Sydney accepts delivery of $40,000 of merchandise it purchased for resale. Okay, so we're going to resell these items from Troy. Invoice 310, net 90. So we have 10 days to get a 10% or to get a 3% discount. Otherwise, everything's due in 90 days. FOB shipping point. Remember, that means it's free to the buyer only until it gets to the shipping point. So not very good. So therefore, the buyer is paying. The goods cost Troy $30,000. Sydney pays $345 in cash to the shipping company. That's not really realistic, but we'll work with it. All right, so let's do our first entry. Notice how they have broken down the first one. They don't even put the shipping in. We're going to put the shipping in second. So from Sydney's perspective, that's who we're doing this first. We got 40,000 of inventory. And we credited our accounts payable to Troy for 40,000. That's pretty simple. So we had 40,000, and this was on May 11th. And we had terms of 310. Okay, now we're going to add in that extra cost. So my inventory down here was 40,000 on May 11th. And also on May 11th, we added another 345 to get the items to our store. So we put merchandise inventory for that cost. Remember, I do not debit shipping expense. Any cost that gets the item to our store, we put it right into that asset account. And it says I paid cash to the shipping company. So obviously we had cash before, who knows what it was. All right, Sydney returns $1,400 of the 40 grand of goods. Who receives them the same day and restores them to its inventory? The returned items cost Troy $1,050. All right, so just from Sydney's point of view though, we're taking off of our account $40,000, $1,400. We're taking that away from our merchandise inventory because we don't have it anymore. That's all we're simply doing here on May the 12th. Take away 1,400. Notice nothing to do with shipping. Shipping was already done. It was a separate event. They're not going to pay us back for that shipping or any of it, any part of it. Sydney pays Troy for the amount owed. All right, so this is on May 20th. We come up here and they get a 3%. It paid in 10 days. Yep, they made that. They paid in 9 days. So all we've got to do is get the balance. Balance of the account shows 38,600 that is due. So I want to come over here and credit 38,600 because we're paying off the entire amount owed, but I'm not paying cash quite that much because I get a 3% discount on 38,600. So I get a discount of $11.58. Take that off of the 38,600 that I owe. So I'm paying cash of $37,440. $37,442. And the discount was the $11.58. Remember, we discount if we're the buyer, we actually discount the item that we bought. So $11.58. Now we go to Troy and we do the same thing. It says for the first one, record the merchandise sold on account. So we go back up here. Remember, it was 40 grand and then it cost us 30. Okay, so our customer owes me 40 grand because we had our sales. And then it's going to say, okay, once you've done that, now we got to record the cost of those goods going out. And it tells me in the problem that the cost of those goods was 30 grand. So my cost of goods sold, 30. And merchandise inventory, 30 grand. 345, the shipping, that doesn't affect us at all because that's something that only Sydney and the shipping company were dealing with. So we don't have to put that in anywhere. On May 12th, we do record the sales return. She returned, remember, $1,400 of stuff. So we call that a sales return. And we take that off of her bill that she owes us. And then we have to do part 2. And part 2 says, okay, how much of that $1,400 was returned inventory to my place that it cost me to actually make it? And it said, of that $1,400 that was returned, it had cost me $1,050. The original cost of that $1,400 before I sold it for $14 was $1,050. So I put that merchandise back on my books for $1,050 and credit the cost of goods sold. And then finally, we record the cash that was collected. So when it's just reversed, our individual owes us $38,600, but they didn't really pay us the $38,600. Remember, they got a discount. So they got cash. We got cash because we're Troy this time, $37,442. The reason we didn't get the full 38 is because we gave them a sales discount. the 1158. And it all, where'd it come from? It came from the amount that was owed. The full amount owed from their receivable was 38.6. Now we can check the work and let's see how we do. That's requirement number 2. Requirement number 1, that looks good too. All right, we're just going to do a couple more and then we're going to finish up for the day. Okay, this one is just like what I did in my example from part 1 of my lecture, where all we want to do is come down here and fill in this inventory T account with the what happened and then the amount, and then on the credit side, what happened and the amount. So let's do that. Remember the top one, it's always our beginning inventory. We always want to start with beginning. And it tells us here that the beginning inventory is on the end of last year, on 2016, was 25 grand. This cost of merchandise sold, this is probably actually going to be our last entry. So I'll come back to that. Now, invoice for merchandise that was purchased throughout the month or the year, 192,000. So I come over here and put in merchandise that was purchased. Invoice cost of purchases, 192,500. Shrinkage determined on December 31st. That means something happened to the inventory, whether it was maybe stolen. Somehow $800 of inventory is no longer on our shelves. We don't know what happened to it. Perhaps it went down in value, it got scuffed. We don't know, but no matter what it is, we call it shrinkage. And we take away on the credit side $800. Cost of transportation in, so that's part of shipping to get it ready to our store. So we're going to put that over here. Transportation in, 2,900. Cost of merchandise returned. This is returned by customers, so that's coming back to us. So I'm going to put that here. Cost of merchandise returned. Let's put, let's see what they want here. Returns by customers. 2,100. Now, purchase discounts that we received. So purchase discounts received. Yes, we get to take it off. And then purchase returns that we did. So this is returns that our customers gave back to us. Now we are giving some returns back to the supplier. So we're going to call this a purchase return for 4,000. And then we come up here as our last item. This is our cost of goods sold, was 196,000. And let's call it the cost of sales transaction, 196,000. And this 20 grand, that would be our balance as of the end of the year. Share work. Actual cost of goods sold, what we would just simply show here is the cost of sales transaction, just show what the T account would be. We have 196,000. Because technically it's not really 196 because the customer did return some stuff. Let's put in the rest of that. Inventory shrinkage, no. Oh, we got to put this one in. The cost of the merchandise returned was 2,100. Let's see here. Purchase returns by customers, 2,100. This is our actual cost of goods sold. The ending balance for cost of goods sold